Hey everybody, it's Bob, Trade Genius. Got my good friend Phil with me. A lot of economic data. What's it telling us? We're going to share with you in a minute. Stay tuned.
Trade Genius.
Hey everybody, Bob, Trade Genius here. Peace, love, and Trade Genius. Spring into some savings with us right now. We got some great specials running. Market is in unprecedented areas right now. We think we got a good handle on it. Go to tradelikeagenius.com. Take advantage of our spring specials. Thanks for listening. See you later. Okay, Phil, are we there yet? Remember the kids driving in the car? Are we there yet? Are we there yet? Is a recession coming? Share your thoughts with us, buddy.
Yeah, we've been warning about one for a while. Thought we might get one last year, and then Yellen did the old T-bill trick to defer it. But there's some forces in the economy that you just cannot really stop. And so we're going to dive into some economic charts that we haven't really done, maybe ever on the podcast in depth. So let's just get into it. So the first one here, Bob, is initial claims. So in my opinion, I think jobs is really the final nail in the coffin for all of this stuff. And, I think you and I both agree that the jobs data is getting completely skewed. If you look at things like, full-time employment, it's falling off a cliff. I think we're going to get into that a little bit more next week. But the jobs data on the surface, it looks okay, right? And that's basically where we're at now. But I think under the hood, I think there's a lot of information that we're getting that's going to say that this number is going to go up pretty quickly. So initial claims is basically at a level where you can't really argue that there's a recession, but what's happening is we're getting sort of this rounded bottom. And if you guys look across several decades, you typically will see a rounded bottom ahead of a recession. But at the moment, we're just not there yet in terms of getting a recession or what they would consider to be a recession. I threw the heat indicator on here as well. And I thought it was interesting because when the heat indicator is giving us that blue shading below, that's actually a great time to start getting long the market because you typically will see a big run up from these levels, these areas where it turns blue. We're well beyond that now, right? So now we're kind of at the tail end of the move. And that's where we kind of want to see when this thing starts to turn this reddish color, pinkish color, that's when you have to start worrying about, okay, maybe the unemployment's going to spike. Okay. We're going to get into some more data that's going to imply that that's coming. But as of right now, the party goes on, right? This is kind of like, if the Titanic's sailing into the iceberg, even when the iceberg was starting to tear into the hull, everyone was eating and drinking and dancing, right? And so that's the phase of the party that we're in right now. Okay, so that's the initial claims. Not there yet. We look at the GDP Q over Q. Okay, if we look at every time we got into trouble with the economy, right? We saw GDP that went negative, specifically about negative 0.25 really is kind of the trigger point for when, okay, we got a recession on our hands. If you look at GDP, we're not there yet. Okay, so the party continues. Again, we know we're seeing it locally, a lot of weakness, but what we make money off of is timing the market, right? And if the market doesn't have the data to turn equity flows into bond flows, for example, then we should be long equities, right? Until TLT becomes the most valuable trade on the planet. And that's going to be when this comes down to that red line. All right. The other metric we have is basically, we're a consumer economy. So if you want to look at orders, new orders, right? This is combining manufacturing and non-manufacturing orders. Okay. This is an interesting chart because again, the red line reading of 47 on this is typically indicative of danger. Now, if we zoom out on this a bit, you guys will notice that we don't have a ton of data. We went back as far as we could, but you'll notice when we go into recession, right, we get an initial dip. Okay. And this is what we saw last year. And we thought, danger, Will Robinson, because once we got that in 2000, we had a little lift and then a big dump. Okay. We got a bit of a reprieve and again, I'm going to blame Yellen for pumping T-bills to try to prop things up, going into the election. But you typically will see a dip and then the real dip, right? So we've seen the dip. Now we're waiting for the real dip. So we got to keep a real close eye on new orders as we start to roll over. We should see this thing crash basically through this 47 line. So while we're not there yet in terms of this, I think we've gotten fair warning of what's coming and we've already had that dip. And that's what we saw last year. And you can see the economy slowing down. The market was slowing down hard with it. So, this directly correlates with the market pretty well, actually. So that's one of the few economic indicators that's very sensitive to the stock market. Next one, Bob, retail sales. Retail is important because we're a consumer economy, right? So here we go. We have, where are we? Well, this one's really interesting and very eye-opening because we're printing 0.5. And 0.5 matters because when you print 0.5, you're going to get a recession, okay? It's just a matter of when. When it was the dot-com bust, we actually printed a 0.5, and right before the recession, the stock market in orange already started to roll over. In the great financial crisis era, again, the stock market was rolling over before we even got a 0.5, but we didn't get a 0.5 until the recession actually started. Here, we just missed the 0.5, so there wasn't really a trigger there, but we did get the 0.5 during the COVID because everything fell off a cliff and everybody was at home. And then we're getting a 0.5 here, and interestingly, in this scenario, the market really hasn't rolled over yet. You might argue that maybe this was a little bit of a preview last year. Things got weak, but then we had you have to understand, Yellen doing the T-bill operation that she's done was a form of QE, okay? Much to the Fed's chagrin because it makes their inflation fight hard. And that's why inflation really hasn't come down. It's been very, very sticky. Even though they say the rate of inflation is coming down, inflation hasn't come down, okay? You're still year over year grinding higher. So we have a big warning flag here when it comes to retail sales year over year, okay? So the final one now, and I think the most important one, and where this is all headed, is going to be personal interest payments. If this doesn't scare you, then I don't know what is. Go ahead and buy NVIDIA at all-time highs if that's the case, because this is implying that pain is coming. And the reason why is because if you notice, whenever we have big spikes in personal interest payments, okay, they always precede a pretty large drawdown in the economy and in the stock market. Okay, so eventually the stock market again catches up with the economy, or in this case catches down, and we get a pretty prolonged pullback. So to put this into perspective, right, we have to go and take a look at a couple of things. So one is looking at the unemployment rate as it pertains to this metric. So the unemployment rate I just turned on, it's this turquoise color, okay? So you'll notice when basically the personal interest payments rises before unemployment cranks up. Remember, we talked about these rounded bottoms on unemployment, right? I mean, it's pretty obvious we're getting a rounded bottom on unemployment. So, I mean, if we could even draw this in here, if you look at it in terms of the leading indicator, right? So here's a situation where personal interest payments rose and led unemployment, right there, okay? And the market goes down. You have this situation here, right? Personal interest payments leads unemployment, market goes down. You had a case of it here as well, right before COVID. And this is why I said COVID, I think, ran cover for really what was brewing under the hood for the economy and a banking crisis, right? And then we had a sharp reduction, although this was extremely short-lived because of the actions of the Fed printing a bunch of money, which personally, Bob, I think was because banks needed a bad bailout. No one understood that. And they ran cover under COVID to print a bunch of money and bail everybody out. And we got taxed with inflation. So thank you very much, Fed. Okay, so how does this compare now? Here is the leading bubble. Here's the leading bubble, Bob, for that. So you tell me what you think the stock market is eventually going to do in terms of correction off of this.
Yeah, Phil, I don't have anything to add to this. This is amazing pieces of information here, guys. The only thing I'll say is that they're fooling us a little bit with a little bit of a mirage because of the inflation rate is higher. So we're looking versus real versus nominal kind of numbers here. And so, we could be in worse situation than we are. I was talking to somebody who said really the wage growth rate needs to be 5.8% for people to maintain their standard of living in this environment. And I think we're at 3.5%. So people are falling behind, and it's just like a slow frog boil. I think the economy's dying one layoff at a time. And we're going to talk about that on Tuesday, the unemployment rate and the games that they're playing there. But also, as Phil always reminds me, and I think it's good for you to know too, is that it doesn't matter what we think or feel or how we know they're being manipulated. Unless the institutions react to it, it's really just a nice piece of information to have. And I think that's what we're waiting on. We're waiting to see those earthquake ruptures. And then it's good enough for us to follow it. We don't have to lead it. And I think we'll be in pretty good shape. The only thing I would tell people is that, look, I think this whole ride up, you should have been rotating out of tech and you should have been rotating into commodities. And eventually you're going to be rotating out of commodities. You're going to be rotating into cash at TLT. I think we're going to get the biggest move on the conjugative wave from, phase 2. Phase 3 might be the shortest phase 3 we'll ever see, and we'll go right into a deflation. So, you guys are going to have to really start paying attention. A lot of money's at stake. A lot of people are older now. You can't afford, you don't have the time to afford a miscalculation. I'd rather you miss the move higher at this point than to suffer, a 40 to 60% drawdown over the next 2 years, because it's very possible that can happen.
Yeah, and Bob, if I could make one more point, if you look at personal interest payments, it kind of forecasts what unemployment rate's going to do. And if you look, over here, as we grow in these leading bubbles, right, you'll notice unemployment, we had single digits here, we had still just under double digits here. COVID was a weird anomaly where we had a big spike to 14. Let's just say that you kind of have to kick that out of the mean equation. But basically what that's implying is we're going to see double digit unemployment because of how high the personal interest payments. It's a direct correlation to all of the rises in unemployment. So, we're dealing with probably unemployment that could easily be up in the 13, 14, maybe even 15% because of how high it's gone. So we're not talking to be dramatic. We're not talking to get clicks. We're talking about data that's supporting a very severe pullback in the economy and double digit unemployment, which ultimately will probably be met with quantitative easing, printing, Fed back buying bonds. It'll be a false stimulus similar to what we probably saw back in 2009 to get us out of the funk. And it's not the healthiest way to get out of it, but it's going to come and then it's going to prop things up. And that's where you get long your investments and you're going to do okay out of this. But, there's going to be a bit of pain, I think, between now and then.
Totally agree. If you guys like what we do, hit like, subscribe, tell your friends, join our service. We just rely on our algorithms to let us know whether or not the momentum's changing, the price action's changing, where we are in the channels. One of these times I'm going to show you this chart, the NVIDIA chart, where the sniper buy went in and a sniper buy that came out at the end of earlier in the week, last week. Scary stuff. Our indicators, we watch all this stuff, so we can help you stay on top of it. Thanks for listening. You guys have a great week ahead, and let's see what happens. Bye-bye.
Trade Genius.